University's Fed Day extravaganza. What I thought we'd do today is go over where we left off with. Last time we talked about the Fed was the Federal Reserve's minutes that were released for the June meeting, which to me suggested this Fed meeting is live, and I think it still is live. So we'll go over the background, where we left off, the data that's come in since then. We'll talk about both sides of the case. What does the inflation side look like? What does the dovish side and the employment side really look like? And then 2 o'clock, we'll get the answers from the Federal Reserve itself. We'll see what the statement says. We'll get some initial reaction from the marketplace. I'm looking at the markets right now. The 10-year's moving down a little bit after selling off earlier this morning on the GDP figures. We'll go over those as they come out. They come out this morning. I think there's a lot in the GDP numbers that the knee-jerk reaction from the marketplace is getting wrong. See the 2 years down to 389. That's moving lower too. So maybe some people getting in their bets before the Fed statement comes out. Now, I think like I said, I think the July meeting, this meeting here is live in the respect that to me, the probabilities are like 49, 49-2. 49% the Fed actually does cut rates. I think that there is a legitimate case for a rate cut here, and it largely rests upon the Fed's experience last year. They don't want to be in the position that they were in September, feeling like they had to catch up to events as they were unfolding. They don't want to do that. They want to stay ahead, or at least appear to stay ahead. And remember, they think rate cuts help. So if they believe the economy is in questionable shape, which a lot of the FOMC members do, they're going to want to get ahead. The other 49%, I think, to placate the dissenters and the doves on the committee, the Fed might, if the Fed does vote not to cut rates, I still think you'll have a couple of dissents. But even if they vote not to cut rates, in order to placate, the dovish side of the committee members and to get more than just, to keep it from more than a couple of dissenters, I think what will happen is if they vote not to cut rates, it'll also come with some language that it'll be more of a dovish language and dovish tilt to it than just specifically, hey, we're good. We're not. I think there's a 2% chance that it comes out, okay, we're not going to cut rates and we're just completely worried about inflation. I don't think that really happens. I think the only two possibilities that we have here are essentially they cut rates, or they say we're not ready to cut rates, but we're going to do that. Maybe we're likely to do that in September. We just want to make sure. We want to make absolutely certain that the inflation fears and tariffs and everything else that we have, they're not happening. So I think those are the two real possibilities. Either we get a rate cut or we get a dovish pause here. And I think as a statement itself will be likely leaning in that direction too. Similar to what we saw after the June meeting, but maybe a little bit less ambiguous. Let's put it that way. Because the June meeting, they presented both sides of the equation, and I don't think we get that here. So let me get the presentation going here, because we have, like I said, there's a bunch of stuff to get going here to go over before we get to the FOMC decision. And let me just preface this like I always do. I do look forward to the day when we don't have to pay attention to the Federal Reserve and what it's doing. And that we don't even know who's on the Federal Reserve Open Market Committee, but that day is not today. So we're kind of stuck with this because that's the world that we live in. So let's get into the background. And really, I think the most important part of this, before we get to the Fed decision, is really about what came out since then. Since the minutes came out 3 weeks ago, the CPI was a big deal. At least it was supposed to be a big deal. Today we got GDP, as I mentioned. There was more concerning in GDP than there was reassuring, let me tell you that much. We'll get into those figures too. Let me get it here just a second, bear with me. Gotta love the live stuff. All right, here we go. All right. So we'll get to the Fed decision in about 15 minutes here. There's, at the very least, there'll be dissent, though. There's still a possibility they do cut rates because the employment side is really looking questionable. So the two main arguments are on the inflation side, it's really just, again, expectations theory more than anything. The idea that tariffs will raise prices or tariffs will force businesses to raise prices, and then consumers and businesses will react to those one-time price increases as if those are inflationary, then they become the inflation. That's expectations theory, and it's complete garbage. But since economists believe in it, therefore central bankers believe in it, it's tough for them to break out of that, to really see reality here. On the other side of things, the employment concerns are not theoretical. Now, we can argue about how weak the economy really is, but we can't argue that there's evidence for the weakness. In fact, like I said, the GDP figures add more fuel to that fire. So we got the inflation argument against the employment argument, where the inflation argument is entirely theoretical. The employment argument is not, which is one reason why I think the Fed is going to lean dovish here. Again, like I said, GDP showed that consumers really are cutting back, and not just for a month or two. This is the first half of 2025. Consumer spending has slowed way down into the danger zone. And then finally, as much as this FOMC meeting might be interesting, it really doesn't necessarily matter to the long run, because the markets are still saying, and like I said, the treasury market even today, the cash market today, after GDP came out, the markets are saying that what we're really discussing here is a matter of timing, when, not necessarily what, or really not at all what's going to happen, that the economy, the weakness in it's going to win out over the long run. So we got to wait another 13 minutes for Christopher Waller to see if he was able to sway enough committee members over to his side. And his side has been, this is what I presented in the last presentation I did, the last live video I did on the FOMC minutes 3 weeks ago. And it already started, back in June. They said, look, we were expecting tariffs to increase prices, and what we found is they aren't even doing that. Now, input costs have gone up. Companies all across the economy have complained about rising prices due to tariffs and other reasons, especially the rejiggering of the supply chains. But they haven't been able to pass those costs along to either other suppliers in the supply chain or to consumers. So even already, as far as the inflation faction on FOMC is concerned, back in June, they were already saying, okay, we aren't even close to the worst case. We're not really seeing what we hoped or what we feared we might see. So the inflation side of it still remains theoretical, where the employment side, including the Fed's beige book numbers, not just the beige book from May, but also the one that came out a couple weeks ago in July, again, referencing layoffs taking place. Labor utilization is way down. So even the Fed's anecdotes going along with the data show that the employment concerns are very real, and they're very broad based. We're sourcing this from a lot of different places, whereas inflation is just entirely theoretical. Again, going back to the minutes, even those who are advocating for a tighter, quote unquote, tighter policy stance among the FOMC, they're acknowledging that it's only meant to be temporarily while they gain more confidence over consumer prices. And once they are confident that tariffs are not leading to the inflation that they think that can erupt, they'll eventually vote for rate cuts. Again, the issue here is more about timing than it is the destination. And is already back in June, a couple of participants said we would support a rate reduction at the next meeting this meeting that we're talking about here today that's about to wrap up. And a couple of participants that's left a little bit open there what that exactly meant. Same thing here. Some participants said that they would support a rate reduction if there one was offered, and they think there's a plausible case for it back in June. So, all right. The inflation side of it, as I mentioned, is entirely theoretical. And it's not even a solid theory. It's bad theory. It's based on expectations. And expectations theory developed in the 1970s. And really all it was a way for econometric models to be able to model a bunch of things without having singularities or infinities in the mathematics there. So inflation theory, as Jeremy Rudd was pointing out a couple of years ago, rests on basically a foundation of nothingness. It's in a model, therefore we believe it must be important, even though there's really no direct evidence for expectations theory as it relates to consumer prices or really anything else. He says it rests on extremely shaky foundations. In reality, it doesn't rest on any foundation other than just the fact that it appears in econometric models. And economists all agree that expectations must play some role, even though they don't have any evidence for what that role would be, or even if that's really the case. They all just say that expectations are a big part of inflation, and largely due to the fact that they don't have a way to explain the great inflation from the 1970s. They had no awareness of the Eurodollar system or money creation outside the United States. And so for them, they're not really sure where the great inflation came from, so it might as well be people's expectations. And that theory has persisted in the absence of any real theory on inflation. So the The Federal Reserve side of it, inflation side, is based on this idea that tariffs are going to push up prices, and therefore it will lead consumers to raise their inflation expectations, and therefore consumer behavior will be altered by a one-time price increase. That's what Jay Powell said at that press conference, and that's what they're really worried about. The one-time price increase leading to a change in behavior. But already the problem with that is we don't see the one-time price increase. We haven't even got that far. So the latest CPIs that came in, as I said in that live video a couple of weeks ago, the CPI would be maybe the more important than the payroll report, and I think that's turned out to be the case, though we'll see just how much that has been in a couple of minutes. We're down to 9 minutes here. There is no evidence that tariffs are being passed along to consumers. If anything, consumer price rates have slowed down, which is a reflection of material weakness in consumer spending in the consumer economy, which I'll get to here in just a minute. So we keep going through all of the consumer price statistics, and it's just not there. You go to producer prices, and it's even less. You would think that among producers, they would be able to pass on higher input costs from tariffs better than they would be able to weak consumers. But producers can't even pass on these costs up the supply chain to other producers. It's just not there. In fact, like you can really see how the rate of change has itself changed. It has slowed down when all of these fears over inflation expectations expected that the rate of change would change, but speeding up. So it's not like we're not just not getting the tariff inflation that everybody thought. We're getting the opposite of what everybody was worried about. We're getting more deflation, if not disinflation, if not deflation, on the producer side in particular, especially when you get into the categories and the sectors of the economy like economists have been worried about all along, which is the services side. That's where they said, sticky inflation comes from services. As far as producer prices and consumer prices go, there's less than inflation. There's less inflation and less price changes in services than not. And even if this is a big one here, the so-called core rate in the PPI. You can see a clear change in trend when this particular metric of producer prices is sort of made not to bend like this. It's supposed to really tease out and identify the longer run trends in producer prices. And you can see here that there's a definite change in trend, not just for a month or two, but now we're talking about 4 months in a row. So even that part of the inflation theory, there's zero evidence for it. It's bad theory to begin with. And up to now, through the month of June, which is the latest statistics that we have, there is zero evidence that it's taking place. Now, again, we know that tariffs are raising costs for businesses, but the fact that they're not able to pass those along is what we're really worrying about here, because that means weak economy. On the other side of things, the employment side, the Christopher Waller faction, if you will, or Michelle Bowman faction. What they've said is, okay, this inflation stuff, we hear you, tariffs, that could be a big thing, but over here on the employment side, we've got actual and legitimate and verified weakness where it comes to especially jobs and hiring. The jolts that came out yesterday, they were a big jolt, especially in terms of hiring. Hiring fell off to the second worst rate since 2020, basically matching on a hiring rate basis, basically matching last June, which basically kicked off the carry trade reversal back then, if you remember. It was the jolts that came out and jolted everybody. Then there was jobless claims. Then the unemployment rate shot up, and suddenly the Japanese were selling everything and anything over that weekend. Stocks plummeted. So we have a hiring rate here in June of 2025 that's basically equal to June of 2024, and both of those at incredibly low levels. So again, Christopher Waller's argument is, we don't just have theoretical weakness in employment, we can see it in the statistics. And that includes, by the way, the ADP report that came out today. While ADP bounced from a slight negative last month to plus 100,000, plus 100,000 is not really much of a bounce back after the negative. And this is consistent with what we've seen in the labor market and economy over the last couple of years. It goes back and forth anyway, but the trend remains lower, which is what the markets are all focused on. Just going this a little bit further, something I do in the deep dive analysis all the time at Eurodollar University, a subscription. We keep track of the beverage curve, not because it's not like something like physics where you have this, mathematical relationship between demand for labor and supply of labor as the beverage. It's basically an illustration of where we might be in the economy, especially in these periods where we're looking for a transition from what we call the vertical part of the beverage curve, where the demand for workers is falling is falling enough that eventually the economy might transition to the flat part, which is where demand for labor falls off so much there's not even enough demand for the labor that businesses have on their books and on their payrolls. And that's when you see unemployment start to rise. So we need a proxy for demand for labor, and William Beveridge came up with the idea of using help wanted ads because that seems pretty intuitive. The problem that we have is help wanted ads. Nobody uses the papers anymore, and the statistic that's put out by the Bureau of Labor Statistics, the BLS, from JOLTS job openings is completely unreliable. You have to make some adjustments just to make it usable. So why not use the hiring number? The hiring is vastly more important anyway. And when you look at the hiring rate from JOLTS and put it in the Beveridge curve format, you see more evidence that the economy is in danger of flipping to the flat part of the Beveridge curve, which means in danger of rising. And therefore, Christopher Waller's argument is that employment is not a theoretical risk. We have evidence that suggests very strongly, makes a compelling case, that if at the very least the economy is in a questionable state. And from the perspective of central bankers, if the economy and the labor market is in a questionable state, then they're going to vote to try to support the economy in any way they possibly can. So the question here for July is whether that means a rate cut now, or does that mean no rate cut, but some dovish language saying that, oh, we'll support the economy if it needs to, is starting with maybe the next meeting. Let's get to while we have 3 minutes left here before the decision, let's talk about the GDP figures that came out because they are more supportive of the dissent than not. So we got plus 3%, which is well above expectations. Analyst expectations on average are about 2.5%, so above expectations. But we got to keep in mind why it is the GDP was negative and why it was positive, why it's so positive, or appears to be so positive here to begin with. And that's the tariff distortion, largely due to trade. Imports were soaring ahead, and imports being a subtraction off of GDP. So they subtracted a huge amount in the first quarter, and then because you didn't have the tariff front-running and front-loading in the second quarter, they ended up adding GDP back. And so what we really have to do here is kind of take the average of the first 2 quarters. So you've got plus 3% minus 0.5%. That gives you a rate of about 1.25% on average for the first 2 quarters of the year, which that's already incredibly weak. And while it sounds like it's a bunch of mathematical and accounting messing around with the numbers, the real important takeaway from GDP was that it confirmed consumer spending has hit a wall. So you see consumer spending, total consumer spending, real personal consumption expenditures at 2 of the lowest rates that we've seen in the 2020s so far outside the pandemic. In fact, you put these 2 rates for an entire first half of a year into the 2010s and everybody would be concerned about these rates. They would be asking what's wrong with consumers. So that goes along with the weakness in the labor market, which tells us that their consumer behavior is reacting to something more than just an overreaction to tariffs. Consumer spending has weakened materially, especially where it comes to services. And this fits with all of the economic data that we're getting on prices where businesses and producers aren't able to pass costs along because consumers are not spending. And the reason that consumers are not spending is the labor market weakness that is not theoretical. That's something that we can see all across these economic statistics. So the takeaway from GDP was we got the bounce back in the second quarter, but that was more of just the variations from the first quarter. And even when you put those 2 together and average out the first half of the year, what you're looking at is weak first half of the year. And most of that weakness is attributable to consumers pulling back. Now, they're not falling off. We don't see massive declines. But again, from the perspective and the context that we're talking about here today, from Waller's perspective, he's, okay, here's more solid evidence that we need to be concerned about the economic direction. We can argue about how weak this is and what it might mean over the long run, but it is inarguable that we have evidence here today and right now, the economy at the very least is in a questionable state. So he has evidence for cutting rates today, whereas the inflation stuff is entirely theoretical. And here we are at 2 o'clock, so let's see what we got from the FOMC. Let's see if Waller's argument won the day, or if we see that Jay Powell. That's another thing we should talk about when we wrap this up here is why is Powell seemingly so hardline hawkish these days? Here's the statement just came out. They are holding at 4.25% to 4.5%. So we have a pause. And let's see who dissented. Was there a dissension? There must be. Where's the votes? They voted unanimously to approve the primary credit rate. Where? That's an implementation note. Voting against were Michelle Bowman and Christopher Waller, who preferred to lower the target. Absent and not voting was Adriana Kugler. I don't know if we should read too much into that. Was this a vote of 6-3? Or are we talking about 7-2, 6-2? So we have two abstentions. Not a really surprise there. We've got Waller and Bowman, who said we wanted to cut rates for the reasons I just cited. Jay Powell got the majority of the committee to vote with him for a pause. Not really nothing surprising here. I'm sure his comments will not necessarily clarify everything when he goes through the press conference. But the statement, just reading through the initial part of the statement, it's basically the same boilerplate. So you can tell what they're saying is they put a sentence here in the first paragraph: inflation remains somewhat elevated. So there's the theory on expectations theory there. The unemployment rate remains low and labor market conditions remain solid. So what they're saying is basically, yeah, we see the weakness in the data, but we're not convinced that it's anything meaningful. Instead, we're still concerned about our inflation expectations theory, but at the very least, you can read a little bit further here if they're talking about a future rate cut. Continue to monitor this. Not really committing to much of anything. I think that will probably come out in Powell's statement more than anything else. So Fed says they're going to pause. They're sticking with their inflation expectations concerns. What is the market doing here? How was the market reaction? And it's always dangerous to put too much as a knee-jerk reaction. The 10 years at 435, the 2 years at 388, so they moved down a little bit from where they were before the meeting. It looks like the 2 years heading lower. So I think the interpretation, again, at least in the knee-jerk interpretation, is that this was somewhat of a potentially dovish pause. Powell's so hawkish all of a sudden? Where is this actually coming from? And I think it's really about, there's a couple things. I think a lot of it has to do with, first of all, there's this political thing, this political argument with him and President Trump. And let's face it, anybody that's in a position that Powell's in, he's going to bristle at the comments made by the president. And so some of this might be personal. Let's be honest here. Federal Reserve officials are certainly human. They have emotions like everybody else does. And you've seen evidence for this all throughout history. This is not abnormal. You think about the political pressure that LBJ put on William McChesney Martin back in the 1960s, the famous Jeep ride. If you don't know what I'm talking about, you can Google that one. But I think that's part of it. There's pushback from Powell against Trump, but more so, I think what's happening is Powell is trying to cement his legacy. He wants to be remembered as the Paul Volcker of the 21st century. So what he's doing is hyping up this inflation risk and saying, I'm the last guy. I'm the one here standing athwart this massive inflationary pressures that we keep getting year after year after year. Inflation, 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 it's everywhere. I'm the one that's standing here saying we need to hold rates, we need to hold rates, we need to hold rates. And so when inflation pressures, at least according to the mainstream, fall off, they already did 3 years ago. That's what the market has said, and that's what all the evidence says. But according to the mainstream story and narrative, he's going to be the guy who said, I held the line, and therefore I'm the reason why inflation didn't break out into 1970 style in the middle of the 2020s. And so I think his hawkish hardline is really about trying to cement his legacy. It's more so a personal vendetta in that respect than it is actual legitimate economics. And the fact that he's leaning on expectations theory to accomplish that just kind of makes you shake your head even more. Because the evidence is on the side of Waller and the rate cutting and the marketplace. Let's end with that one. As I talked about recently with the video we did with Steve just this past weekend, the market continues to anticipate a series of rate cuts out of the Fed. What the market is having trouble deciding and predicting and forecasting and pricing is when that will happen. As I said in the presentation that we just did, the question is about when, not what. So Jay Powell eventually will be satisfied on the inflation question because it is not even a question. And once he does, the dissenters on the FOMC will take over and say, look, we've got all this economic weakness we probably are going to need to catch up on. So I think the markets are saying, look, I know what the markets are saying interest rates are going to go down. We just don't know when and in what fashion, which that's an incredibly difficult part of this too, because rate cutting cycles are not really cycles. They go in fits and starts because policymakers are institutionally biased toward inflation to begin with. And they think rate cuts are powerful stimulus, so they cut rates by a lot, and then they sit there and say, okay, we cut rates by a lot, that'll work. And then a couple months later, they finally realize it didn't work, and then they pick back up on the rate cuts. So the rate cutting cycle is already difficult to try to game plan to begin with, and the Federal Reserve is making it even more difficult by this ridiculous bad expectations theory that it continues to stick to. So the market's still saying we know what's coming, we just don't know when it's coming. And the one last thing, this is not unusual either for the Federal Reserve. If you go back to the 2018 and 2019, the Federal Reserve was higher than everybody else, and it took them longer to start cutting in 2019 than everybody else. So in many ways, the Fed, and the J. Powell Fed, is still playing to its same type as before. So the market says we're pretty sure about where this all ends up. We don't know when J. Powell will be satisfied enough for his legacy, but that's going to come at some point. It wasn't here in July. So now the question turns to, what happens in August, and does it raise the risk that we repeat last year, where the Fed has to feel it needs to catch up and cut by 50 basis points in September? So that we'll find out. Look, the 2 years falling even further here. So yeah, I think it's not a huge move, but the initial market reaction is what I said. It's a dovish pause. The Fed is holding rates, saying we think we're probably going to end up cutting. We need to have more clarity on consumer prices. So let's end it there. Thank everybody for joining me here for our special live presentation of something that I hope we never have to do again. But we're going to have to continue to do it because everybody still believes the Federal Reserve is the center of the universe. And as we're seeing that the economy doesn't necessarily care what the Fed does, nor do the markets, except for the timing. So everybody have a great Wednesday afternoon. I'll see you again very soon.